I think it is desperation. It's desperation for people trying to be able to buy. The incredible amount of demand and the undersupply of properties we've got. They're sort of a bit paralysed because there's this horrible fear that if they sell, they could end up being homeless and not being able to find something. So if you bought it in a trust, some lenders have a policy in place where if that lending for that property becomes cash flow neutral, you could exclude that debt from assessment when you go and buy another property. If you had a $200,000 home loan, which is tiny these days and very easy to service, that would cost you the same as having $1 million worth of investment loans because you've got the tenant paying a fair whack and you've got the tax deductibility helping you.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
So, interest rates have stabilised, but the finance games continue to change, and it's becoming almost harder than ever to navigate lending and stay one step ahead. And it's just a real challenging time to be able to get your finance in order and get into the property market, both with either another investment or your first home, as many are trying to at the moment. So I've got Nick Aves from Purely Finance back on the show, and we're going to really pull apart how we can help borrowers in this shifting market and the forecast for things ahead. So thanks for joining us, Nick.
Oh, welcome, Jared. Thanks very much for the opportunity to come back on the podcast.
No worries. Well, I always enjoy our chats, and often we get 10 minutes into a phone call. I think, geez, I should be recording this. So today we've hit record, and tell us a bit about what's happening right now and what you're seeing on the ground, because you're doing this every day.
Yeah, I think mainly what we're seeing, I think, is it's desperation. It's desperation for people trying to be able to buy, and you'll be seeing that probably more than me in relation to just the incredible amount of demand and the undersupply of properties we've got. So that's really creating challenges for people that want to purchase something in the market. And it's also having an impact on people perhaps wanting to downsize or to move. They're sort of a bit paralysed as well because there's this horrible fear that if they sell, they could end up being homeless and not being able to find something. And what we're seeing is a market that is just moving ahead in prices every day. So things keep changing. So we will see clients and they will have a budget in mind of what they want to spend, and we'll get all their ducks in a line and we'll work on that, and everybody's good on that. Of course, then they go into the market and they may be seeing properties that are priced a bit below that, and they're going in there and they're putting in offers, and the price, of course, is going for significantly more than what they thought. So they're having to reset. They're having to come back in and see us and say, look, that was what we were comfortable at. But, what can we borrow more? Can we go to a high level? What does that look like? What do the repayments look like? So I think people are having to reassess the cost of housing on their budget and to see if they can make that work. And if they can, upping perhaps what they're going to spend. And that's true for owner-occupiers and investors. So investors, we see people that want to get into the investment market. They have an idea on sort of what price range. And then I think once they get out there, if they haven't been active in the market, they get a shock for what they can actually buy. They're coming back and saying, well, what if we buy something for a bit more, and that sort of thing. The challenge with that, of course, is not everybody can actually get to where they need to get to. So we're seeing a bit of desperation. I think if you've got one word for the market, it's probably people becoming a bit desperate.
And are banks easing their policies, or is it becoming any easier with, I guess interest rates have decreased a bit over the year, which gives people a bit of extra borrowing capacity back, but has that changed things much, or is it sort of business as usual?
This is wishful thinking, isn't it, Jared? It is business as usual. There has been some chatter in the industry, and certainly some of the lenders, I think, went to the regulators and said, look, interest rates are at a level now that maybe we don't need 3% buffer. Would you consider reducing that? And the answer was a hard no. So for deposit-taking institutions, they're sort of limited to 3%. What has changed is just the number of lenders in the marketplace. I know on our panel now of lenders that we operate with, it's just grown and grown and grown. It's just a huge amount of lenders on there now. And there are specialist lenders, and there's lenders coming into play that have more liberal policies. So some of the lenders that we've been using have, rather than a 3% buffer, a 2%. And apparently they can do that because they're not regulated by the same regulators because they're not deposit-taking institutions. So that means they can borrow more because the buffer's only 2%. And there are some lenders on there that will do 1% buffer, the specialist lenders, but their rates are a little bit higher. So, it's all very well that the lender will lend, but sometimes you're paying a slightly higher rate. So, of course, from a cash flow perspective, it is negative. So you've got to be comfortable with your cash flow that you're going to be in a position where you can actually meet these repayments and still live your life. But to answer your question, no, lenders aren't really changing their main policies around serviceability and affordability. They're always coming up with policies to try and find a niche in the market where they can grab a bit of market share because it's extremely competitive. And there's other players coming in that's opening it up. But generally, the lending standards are being maintained and it's still pretty tough to qualify, and you have to sort of jump through the hoops to confirm everything. Yeah.
One of the changes I've sort of heard about, which I don't know too much, so it might be interesting to get your take, is that I know with many investors that have already sort of built larger portfolios, they've been looking at, ways to get around trying to get extra borrowing capacity and using, fanciful things like trusts and other ways to silo the lending and then not have it count towards their borrowing capacity. But I've heard that one of the bigger lenders has come out and is no longer doing it. And when I create strategic plans for people, I've always tried to keep them within the conservative big, banks lending criteria so that if they ever need to refinance or if they ever run into trouble, they've got options there and they're not boxed in. Imagine, you're only with one or two lenders, they change their policies, you can't refinance at the end of the interest only period. You switch on to principal and interest and then you at the same time, you might have some vacancy, whatever. All those things can cause someone to sell when it's not the right time, as we've seen in the past when policies and things change. So what's been your sort of approach to, I guess, or what have you seen from lenders and how they're treating that type of structuring? And
yeah, so trust lending, it's all over the socials in the property investment world. There's a couple of things in relation to that. I had a big conversation with a client about it just the other day. So one of the main lenders, probably can't name them on this, but you're right, they pulled the policy and they pulled it very aggressively. It was effective immediately. And even if there was loans in place that had pre-approvals in place or loans that were in place going through assessment, was stopped dead. So they just said straight away, we don't want to do it. And the reason being is that lenders came out and said, look, we are aware of how this is being promoted by some people in the real estate industry. We believe it's trying to circumnavigate responsible lending and we don't want to get caught in that space. So they just blanket stop some people. And some people are purchasing the trust not for a serviceability maximization, but for an asset protection and things like that. So that was unfortunate because that lender was really the go-to for trust lending. They had a really good policy, really rates, really good service. So when we had trust lending,
well, friendly for business owners as well, who arguably they're doing it for the right reasons. They have their business in a structure and it makes sense for them to distribute, money around and then sort of have the asset protection angle as well. And so, yeah, it's a bit of a shame that everyone's now not getting access to that as an option.
Yeah, that's right. As a result of that. So basically the idea was if you bought it in a trust, some lenders had a policy in place where if that lending for that property becomes cash flow neutral, you could exclude that debt from assessment when you go and buy another property. So normally what would happen is if that property is in your own name, you can't exclude that debt and the banks have to apply the assessment rate to the existing debt at 3%. So if you've got all these different loans in your name and even if your cash flow is positive, the way the bank looks at income and the way it assesses the debt at 3% higher for a potential repayment, if rates rise, you fail servicing.
Yeah, so basically they count that loan normally from what I'm hearing. And if it was neutral and in the trust, you could exclude that loan and not have any.
That's right.
Buffer rabbit on it.
So it's not like a drag on your borrowing capacity for the future. Often you'd need to get somebody like an accountant or somebody to sign off to say it was neutral. with trust lending, we won't get right into this, but the big issue with trust lending is if you work for somebody, is you're losing your negative gearing ability. You can't offset that paper loss against your income. So in effect, if you've got that property in a trust from a cash flow perspective, it's actually worse for you because you're not going to get your tax deduction back and you're going to end up paying more tax. So it actually hurts your cash flow, but it may increase your borrowing. There's an ethical issue there, I suppose, for a broker, in as much as if you are going through a trust and excluding that debt, what happens if rates do rise and the client is in a cash flow perspective and can't afford the repayments? So you sort of want to really be having these deep conversations with clients. And I know people in the property investment space, it's like maximize your borrowings, maximize your borrowings, maximize your borrowings. Things always go up, rents always go up, and life's always sweet. But we have seen in the past when we had the GFC and all the lending got a lot tighter, a lot of people got really burned, what you were talking to before, where they were on an interest-only loan. It had been renewed, so they now had 10 years interest-only. The loan had rolled over to a 20-year P&I. Rates had gone up. They couldn't afford the repayments. Rentals had gone down. And in Perth, the value of properties had gone down, so they had negative equity. And they were really at a really tough place. So we don't want to see that. So I suppose my view a little bit is that the banks want to lend you money, but that's their business. And they're very aggressive on pricing. They're very aggressive to try and get the business. And they're in the business of understanding risk and doing it. If the bank policy is saying, look, you can't afford this if rates go up by 3% and you're going to get yourself in trouble, so we're not going to lend you the money, you have to be pretty sure of yourself and pretty sure of your position that if that does happen and you have got the money via some quirk of policy or whatever, that you're not going to shoot yourself in the foot. So I think it's about having these detailed conversations with clients, understanding their position and making sure people are fully aware that the debt they're getting into is something that they are going to be able to live with. The biggest risk with property investing is the debt. You've always got to manage the debt. And what I always like to say to my clients is, you need to be the person that's in control of when you buy and sell that property. In particular, sell the property. You never want to lose control to a lender where the lender's telling you when you have to sell it, because that's when you can potentially lose money. If you're in control, we all know markets cycle. You can decide when the time is best for you to sell it. It's your decision. You're in control. And that's what we want all our clients to be in.
Well, even in this environment, every so often I'm still having people go through difficult times as you do. And thankfully, with the market being up, we can readily sell a property and get, much more than they're ever expecting and clear that loan and still have a happy story. But you just want to have your buffers in place as well and not go completely to the wall whenever you're designing your portfolio and your overall finance strategy, because then you can ride these things out and have time on your side. So,
well, I think that's it. I think if you're in this game of finance and property and that sort of stuff and investing, what you're wanting is your clients to do well. You want them to move ahead and create wealth and have a better life. That's the whole point. What you don't want is them to be overstretched and overcommitted, and it has a negative impact on their life. So we don't want that. So we're going a bit off track here, really, aren't we? But
I think it's really topical and worth covering because we've never touched on it before in our previous finance chats, and it definitely is a big risk I see for people that have gone down that road pretty heavy at the moment. So thanks for your idea.
You've always got to respect that debt, and you've always, I think, like you said, you've got to have the buffers, you've got to have the things in place that you're in control of it. So, because not everything goes up forever. And, Murphy's Law is that if you own multiple properties, we all know the rates all come in at one time, and that can be pretty pricey, but things can go wrong at the same time as well. You might lose a tenant, you might have some capital works that required on the property, a hot water system or whatever. So you've got to have money there for these times, because insurance policies and stuff like that take time to collect that money. So you've got to be in control, and you've got to have that buffer in place. So yeah, that's good.
The other segment of the market I really wanted to touch on was first home buyers, because I'm seeing them more active than ever out at home opens, and at the moment I'm also seeing a lot of parents tag along, and I know from their offers that they're a lot more involved than ever, and it's great to be in a position where you can help your kids and really give them a leg up. Are you seeing that on the finance applications you're preparing, and where is the sort of bottleneck for people at the moment? Because they've got all these extra incentives and ways to get access to money, but is it sort of, you still have to be able to afford it like we've just spoken about?
Yeah, that's right. So it's never been better from that government guarantee perspective, where you need 5% plus you need, in most cases, 5% to cover the cost. So you sort of need 10% deposit, and you can get into the market with no lender's mortgage insurance in Perth if you're buying a property under $850,000, and it doesn't matter how much you earn. So that's pretty amazing. I mean, that from a concept, it's never been easier. The issue is, though, of course, is affordability, because house prices are so expensive that 10% is still a fairly big deposit because of the price of houses. And the other thing is income that you need. You need substantial income to be able to get into the base level pricing.
And it's so different with a home too compared to an investment. I mean, every time I'm creating a strategic plan for someone, we can go buy 3 investment properties, maybe even 4. And the moment that you switch over to wanting a home for a considerably lower price and planning in your home upgrades, like just being able to afford it, and especially on a P&I loan, like people always underestimate how difficult that is without having a tenant to pay your rent, which would be great if we could still have a home and have a tenant paying for it.
Yeah, well, I always say an investment loan, it's about, there's 20% of the cost of our owner-occupied loan. And it depends, everybody's circumstances are different. It depends on the property and all that. But just as an example, if you had a $200,000 home loan, which is tiny these days and very easy to service, that would cost you the same as having $1 million worth of investment loans because you've got the tenant paying a fair whack and you've got the tax deductibility helping you. Whilst with your home loan, you've got nobody helping you. It's just you. You get paid your income, the tax disappears, and then you've got to live and pay your mortgage. So yes, what we are seeing is that people are bumping up against serviceability. So some people are having problems saving the deposit, but often the clients we're seeing seem to have pretty good savings. So people have been aware and have been saving money. So I take my hat off to them. It's not easy, but people have been saving good deposits. The issue is serviceability. And if you're a single person, it is incredibly difficult to buy a house in Perth on a single wage unless you're earning really good wages. An example is I'm working with a client at the moment. He's a solicitor earning about $120,000 a year. I managed to save up $170,000. So he's thinking, man, when he came to see me, he thought, well, I'll be able to buy a place for about $1 million, is what he thought. When we look at his borrowing capacity, he maxes out at about 670. So when you put the costs together, take off his deposit and everything else, the maximum he can buy a place for is $800,000, which is still a lot of money, right? For a single guy, he's got no other debts, no HECS debt, everything's paid off. But I've had a meeting with him. I said, well, 800's it. He's been back on the phone to me and said, look, can I go a bit higher? What's the, how can I say what's income? You have to go to your boss and ask for a pay rise, or you're going to have to bring your girlfriend in and buy the house for you. I just don't have 2 incomes. So it's tough. And he's been out there in the marketplace and he keeps missing out on properties. So he's looking at properties in the $700,000 mark and putting offers up to 800 and keep missing out, right? So he's saying, well, there's not much out there. I was hoping to get a house with a little bit of dirt. I might have to look at an apartment. So for him, it's very much done a really great job with his savings. Professional, paid off his HECS debt, got no other debts, on a good income.
Yeah, it'd be pretty disheartening to.
Yeah, but as a single guy, he can't do it. It's hard to get into the market. So what else can he do? Well, he's going to have to go either further out and buy something cheaper. Ideally, you sort of want to be close to the town. He works in town and that sort of thing. He's saved up so much money, he doesn't have a car, right? So all his money's been going into savings. So he catches public transport and that sort of stuff to work. So where he lives at the moment, it's close to transport, close to the city. So that's what he was hoping to buy. But he's going to have to do a lifestyle change or get a higher income. But, as quick as he can save, of course, the market's moving away from it. So he's actually going backwards. So he sort of just needs to get into the market and do it.
Just real quick before we continue on with the episode, are you getting my email updates yet? If you're not, you're missing out on our suburb intelligence reports, which we tailor and prepare for your individual suburbs of interest, showing advanced stats and insights. Must get onto those. And I also send out exclusive invitations to our events, including webinars, sundowners, and workshops. So if you're not getting those, head on over to investorsedge.com.au/join and make sure you're receiving my email updates.
Or we go back to looking at what you just said about you can borrow 5 times as much as, or service as much with an investment property versus otherwise. And if you can only afford a villa or a unit, well, maybe you look at renting and Rentvest.
So Reinvest would work for him because he has a really good deposit. He would, and being a solicitor, we might even be able to get him a lender's mortgage insurance waiver. But the issue with a lot of the clients are they can't do the Reds Invest because they need the government guarantee. And you can only do the government guarantee for an owner-occupied. So the bank's assessment is on owner-occupied. So they're getting a bit caught out there.
It's almost that middle ground, isn't it? Where it's like you can't have enough to get what you really want for your home. And you have to start making some compromises, like you're saying, but might not yet be strong enough unless you fit into one of those other, classifications like medical or accountants or whatever that qualify for a higher loan without lender's mortgage insurance. Yeah.
Yeah. As an investor, you could pay lender's mortgage insurance, that's fine. But the issue being is some people don't have a large enough deposit. So they don't qualify for the lender's mortgage insurance.
Does that usually start at about 10% deposit needed?
Yeah. So again, you need sort of 5% deposit to cover the purchase costs for an investment property. You need a 5% deposit to get to 95%, but then you've got to cover the lender's mortgage insurance. So the most you can go to is sort of 95%, including the lender's mortgage insurance. And if you said the mortgage insurance was 3%, you sort of need 13% as an absolute minimum. And if you go above 90%, the lender's mortgage insurance is very expensive. So ideally, if you can have 10%, 5% of the costs and 3%, you're sort of up 17 or 18%, you then end up with a 90% load. So with lender's mortgage insurance. So it gets a bit tricky. To answer your earlier question, some people are very fortunate and their parents are assisting them a little bit. So yes, we are seeing that. And the assistance is coming one of two ways. So the parents can't do anything about the serviceability assessment. You can't provide a servicing guarantee. The servicing just has to be done on the applicant. So for some people, if they're going to do the Rent Invest, we've been using a parental guarantee for that, security guarantee. So that way the deposit required is smaller. They can get into something in the market as an investment property. They may still live at home with mum and dad, but at least they've got an investment property. And the idea being, I suppose, down the track, as their income increases, they can look to maybe move into that at some stage in the future. So that's a really good option for some people. Yeah, and we are seeing some gift funds as well. So I think some parents, maybe they've invested themselves. They're in a position which is quite strong now. They sort of have obviously looked at their own finances or sought advice on that, and there's more than enough there. And they sort of think, well, maybe we can help our kids out now rather than to wait until we're gone. Let's help our kids into housing. So very fortunate if you can do that. I suppose, that can be a driver for why people today are looking to invest and do things like that, because they realize how hard it is and they want to be able to help their children down the track. And I hate to say it because it's never been the way Australia's been, but it is becoming those that have property and those that don't. And there is a divide there, and I can see it getting worse. It's hard to see how some people are going to be able to get into the housing market, and that's not good for the country, but it's the reality. So I suppose if you're in a position where you're sort of sitting on the fence about, should I consider investing? Should I, look at doing some stuff with my money to try and create some wealth? I mean, that's a pretty powerful reason why people should consider it. But, they may want to be in a position where they can help their kids or grandkids even at a later date to actually get into the market. Yeah.
Well, I guess we have to look to some of the other more expensive cities, even in Australia, like Sydney, where people have just had to embrace higher density and not always start with the type of property that you'd necessarily want. And the other trouble in Perth is we don't have a lot of that being ready or being built yet. So the options aren't there. And that's why apartment and unit prices are getting pushed up so strongly at the moment as well, because there isn't that supply. But hopefully in the years to come, there'll be more options and cheaper ways of building or delivering a house so that we can create more affordable choices for people that are lacking at the moment.
Yeah, it's a massive problem in Perth. I mean, we don't have the builders. We've lost a lot of the builders that could do the high rise, and the numbers weren't working for developers. I mean, there's just so much red tape and all the rest of it, and construction costs going up that it just made no sense. The only apartments we seem to see going up are the ones that are really upmarket apartments where people pay a premium to keep in the area where they've lived and downsizing their house into a luxury type apartment. But that doesn't do anything to help people trying to start off. So you're right. There's a huge demand for it. And I mean, government's aware of it. They're talking about it. The industry's aware of it, but there's no quick solution. That's part of the issue. And like I said, hopefully some alternative building methods and alternative products will help that. But it's, we have got a crisis at the moment. We've got a housing crisis, and it is tricky for people.
So I guess thinking ahead to 2026, what's on the horizon for you, and any advice to people that either have been thinking about still getting in or have been looking for some time and been missing out? What are your thoughts?
I think it's hard. I'm not a property person, and I know you speak about this more, but it's hard to see the market coming off. So some people I have spoken to who've been a bit disheartened have said, look, we're just going to wait till the market crashes and then we'll come in and buy. And I think that's a flawed policy, because there's nobody can time the market. But I think if you can get into the market, you should. Because none of us can tell, but all the statistics and all the things we talk about building, stuff like that, leads us to believe that there's going to be an ongoing shortage. And if it's a shortage, that tends to lead to competition. And if there's competition, it's rising prices. So I think if you can get into the market, you should. It's critical that you work with somebody to check what your borrowing capacity is and get your ducks in a row. You just can't go into a home open and put an offer in without being pre-approved or having a letter of eligibility from a broker. You've got to do your homework. Things that can make a big difference are really any existing loans that you've got. So things like afterpay facilities. It is interesting how people have bought something through a big shopping electronic shop years ago. They got a card for it. They paid it off on it, but they've still got a facility there. So it's worth checking your credit file, see what's there. Any of these old things that you don't need to close them off because they'll maximise your borrowing capacity. HEX debt is an interesting thing. I've got clients at the moment who are upgrading their home. The only way we could make it work was for her to clear her HEX debt of 12 grand. By clearing the HEX debt of 12 grand, increased the home loan by 50 grand. So, it made sense to pay that out so we could get the loan so they could complete the transaction. So you've just got to look at all these things that we can do to maximize your borrowing capacity if you're going to go into the market. But buying is still really tricky. It's incredibly tricky. So I've been talking to some of my clients about buyer's agents, and it's something I've never really done in the past, but I think the market is just so difficult that you sort of need a professional almost to help you. And I think it's money well spent. So I think that's a consideration. I suppose it's the basics. I've heard things like clients putting a personal letter together to give to the real estate agent with their expression of interest, saying, I suppose a bit of a sob story. But they're saying, look, we have got our pre-approval. We're happy to be flexible with our settlement date. If they want a bit longer or they want it shorter, we can do with that. We're a family of two looking, we have a kid or couple of children. We love the area. We want to go to the school. We love your home. We want to make a family home for it. Putting that in the offer to try and get a bit of the emotional side across as well. Selling yourself. I don't really know if that helps, but I would imagine with some sellers, particularly if it's their home, the idea of it, if that's been their home for a long time and they've raised kids there, the thought of another nice young family coming in and raising kids in the same area is quite attractive. And that could make a difference if your offer's not too far out. potentially. So I think it's just trying to do all the little things. Certainly when you're going into the home opens, I listened to your podcast today, Jared, but you're right. The people come and actually introduce themselves to you and make a personal contact with you, you're going to remember them. So when when you're presenting the offers, you say, well, these seem like a really nice young people, and they've got their finance organized and da. Because I can imagine people often putting offers in and they're sort of landing about the same amount. So then who do you pick? I always talk to my clients about putting an odd number in. If you're thinking of putting an offer in for 800, why not put 801 or 801 500? Everybody just goes to the next 10 grand. So if you think you can go your maximum 690, go 691, because there might be 5 other people at 690. You're the only one at 691.
You know how many properties we've bought on our buyer's agency side with the odd number? Like over the last year, it would be at least 10 that we've gotten over when we're 1K higher, and then the rapport and the relationship carries the rest of the way. But the agent at least has a little monetary reason, and they have their emotional and confidence reason. And I love that idea that you just said of giving the background and the story. There's many sellers that I've had that have chosen a home buyer couple that they felt were really going to love the place over an investor, for instance, that was 10K higher, just because, they wanted that person to make it their family home and for it to be passed on to someone that was really going to appreciate it and enjoy it. So
lose your home, you put there's a lot of memories there, obviously, but there's also a lot of love and work and hard yards. Probably you want somebody to love it, don't you? It's sort of like it's something you've created. So yeah, I think that's very powerful. What else? I don't know. I think you need to be prepared to meet the market as well. There's no point banging your head against the brick wall, wanting to be in a particular area, if the sales evidence is showing you're not going to do it. You're not going to get a bargain in this market. So you need to go to where you're going to be competitive and have a chance to buy.
And my advice is you can't even look at the sales evidence now. Like, you've got to know what stuff is under offer for and chat to the agents to find out. And whenever we're buying, for instance, I get to know the top few agents in an area. This is what we do on our buyer's agency side. And then when something comes up, I like to call them and say, hey, have you seen, 123 Smith Street? What's your take on that price compared to other stuff you've got under offer? Because what's under offer counts. That's the freshest sale that hasn't even hit the record yet. So if you can find out that stuff's going for an extra 30 or 40 and you've got the budget for that, then that, makes you feel a lot more confident about paying that on the one that you're going in for. So that really helps as well.
Yeah, that's good advice. It gives you confidence to go in with that price. Yeah. So, but unfortunately for buyers, I can't see anything that's going to change the market for a little while. Obviously, this first home deposit grant up to 850, you can see the market powering away to that sort of figure. Investors, if we've had investors and they're sort of around that mid 800s, we've been telling them to pitch above 850 to blow out the first home buyers, which is not good for the first home buyers. But if you think it's worth 850, well, don't go 850, because there's probably 3 or 4 home buyers that are going to go into 850. Go slightly above that as an investor.
Now, that's good advice, Nick. We've got a couple of clients that are at an 800K budget that they've set on the investing side, and I'm going to go back straight after this podcast and see if we can do 851.
Yeah, exactly.
So you might be getting a few calls when this episode comes out.
851, that's straight up. And the number 8 actually, for some vendors can be quite powerful. So it's interesting. I was having a chat to some clients and I knew the vendors were from Asian descent. I said, put a couple of 8s in the offer. And interesting enough, they got it with the 8s in there. So lucky number. So there you go.
Yeah, good one. Whatever works, I guess.
Yeah, exactly right. Yeah.
So any final tips to leave for people? We've covered so much today, and I feel like there's a lot of insights already. But
I mean, obviously a lot of investors listen to this, so we are constantly looking at investors' portfolios. So if you're an investor at the moment, it's a really good time to refresh your borrowing portfolio. Often what people do is they take equity from the family home, they buy the investment property, so they might take 25% from the family home and 80% loan on the investment property. But the way the market's gone, that investment property, now the borrowing's probably at 50% or something like that. So we can take that loan off the family home, put it onto the investment property, refinance that over a new 30 years. A lot of the lenders are giving discounts for loan to value ratio bands. So if you sort of get below 70% or 60%, you get a cheaper interest rate. So some really attractive rates out there, and we get it to be a standalone.
Well, it's especially good if they're not planning to add anything else and they just want to consolidate things down and they're going to go into a bit of a parking money and offset and repaying debt sort of phase, and why not get your loans as cheap as possible?
Yeah, even if they are thinking of getting those properties standalone. So sometimes people do what's called cross-collateralisation. So you have a home loan, you just bolt another one on and another one on. They're all sort of linked together. Now's a good time to unlink all those and say, well, that's the loan for that investment property, standalone, secured by that investment property. That's the loan secured by that one. And then the home is hopefully debt-free or has just got a small mortgage on it. Uncoupling the family home makes it a lot easier if you sort of, for example, wanted to upgrade the family home or downgrade the family home. You don't have to worry about all these others. It's already done. It's already sorted. So, and by doing that and getting them back onto new loans and things like that, of course, what you're doing is you are looking at increasing your borrowing capacity. So you're sort of getting those loans again over 30 years, extending the term, reducing the repayment. The aim being that we want to smash down the owner-occupied debt, not so concerned about the investment debt, but investment debt can be repaid as well depending on the situation. So everybody's situation is different, but it is worth looking at your portfolio. And because of the growth in asset prices Australia-wide, it's not a bad time to renegotiate that and restructure that if it's appropriate.
Well, it just gives people a lot more options now as well. So they might feel like they're overly concentrated in Perth, and maybe it's then time to look at buying somewhere else and getting a bit of geographical diversity and still looking at that. The downside, unfortunately, about other places like Melbourne, for instance, where we're buying for some clients, is that the yield there is just so much lower. So it makes it harder as an investor to make the numbers stack up. So
yeah, I was chatting to a client about that the other day. So obviously they're a lot earlier in their cycle, so there's probably some potential growth for Melbourne. It's sort of had quite a hard time, but you're right, the yields aren't good. So from a cash flow perspective, it's costing you more at this stage. But longer term, who knows? So
awesome. Well, thank you so much for joining us today. If anyone wants to get their finance looked at by an investing expert, and you also work with a lot of home owners, I guess why I like your approach to finance, Nick, is it's all encompassing and really has the wider strategy involved. So you need someone that's going to look at the whole picture and not just focus on that single loan that's in front of you and then discover that you've trapped yourself and you can't then do your steps after that. So
yeah, it's very much, you got to work, it's a relationship rather than a transactional base. And it's about trying to get to where you eventually want to get to and not tripping yourself up. So yeah, you're right. That's important.
Well, I'll put your details in the show notes so anyone can reach out. Good time of year. I love end of year to doing all these kind of the things and just resetting for the next year of 2026. And I think if you're going to do anything property-wise, getting your finance house in order first is the best place to start. So thanks heaps for coming on today.
You're welcome. Nice to speak to you. See you, Jared. Bye.
Just a reminder that the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.